welcome back to the channel. In today's video, we're going to break down this chart step by step and understand how the market is actually moving, not randomly, not emotionally, but in a very structured and intentional way. If you've ever felt confused watching price move up and down, or wondered why the market suddenly reverses exactly where you didn't expect it to, this video is going to give you clarity. Before we start, make sure you subscribe to the channel. This channel is fully focused on education, especially smart money concepts, explained clearly, slowly, and with real market logic, not hype or signals. Now let's begin. In this chart, we're working on the 30-minute time frame. And the first thing I want you to understand is this. On this time frame, the market is not moving randomly. Price is following smart money logic. Every push, every pullback, and every sharp move has a reason behind it. So instead of guessing, we read structure. Let's start from the left side of the chart. Here, we can clearly see that price is making higher highs and higher lows. This tells us that the market is in a bullish structure. Smart money always needs structure before they do anything meaningful. They don't enter randomly. They build structure first. At this stage, retail traders usually get excited and start buying aggressively, believing the trend will continue forever. But smart money thinks differently. Now look closely at what happens under the break of structure. Before price actually breaks structure to the upside, we see a liquidity sweep forming below the previous lows. This is very important. That move below the lows is not a trend change. It is a liquidity sweep. Why does this happen? Because below those lows, there are stop losses from buyers and sell orders from breakout traders. Smart money needs that liquidity to fill their positions. Liquidity is fuel. Without liquidity, the market cannot move. So when price dips below that level, it is intentionally grabbing liquidity, not because the market is weak, but because smart money is preparing for the next move. This is why we say the market moves from liquidity to liquidity. Right after that liquidity sweep, price aggressively moves upward. This brings us to the next key concept. Break of structure. When price breaks above the previous high with strength, this confirms that smart money is in control. A break of structure is not just a line being broken. It is confirmation of intent. It tells us that smart money has finished collecting liquidity, they now have enough orders filled, and they are ready to move price in the intended direction. This break is what separates random price movement from directional bias. At this point, the market confirms bullish intent, but we are still not done. Now, after the break of structure, price continues moving higher, and this is where many traders make a mistake. They think the trend is strong, I should buy now. But smart money does not chase price. They wait, and this waiting creates the next key concept. Point of interest. As price moves up aggressively, it leaves behind an area of imbalance, an area where price moved too fast. This area becomes a point of interest. Why is this important? Because smart money often returns price back to areas where they previously left unfilled orders. They don't enter all at once. They scale in, they rebalance. So this zone becomes a magnet for price in the future. That's why we mark it, not because it looks nice, but because it represents institutional activity. Now look at how price behaves after reaching higher levels. We see price slowing down. We see hesitation. We see overlapping candles. This is not random. This is where smart money begins the next phase. Inducement. Inducement is one of the most misunderstood concepts in trading. Inducement is when the market intentionally creates false confidence. In this chart, price stays high long enough to convince traders that the uptrend will continue. Retail traders start buying late, they move their stop losses closer, they become emotionally committed. But smart money is not adding here, they are setting a trap. Price then moves downward aggressively. This move is designed to trigger fear, stop out late buyers, force emotional selling. This is inducement. It is the market pulling traders into the wrong decision so liquidity can be collected. This is why inducement usually happens before the real move. And notice something very important. This inducement move is not random. It is driving price directly back toward the previously marked point of interest. That is not coincidence. That is alignment. Structure, liquidity, and price delivery are all working together. At this stage, we now understand the story of the chart. We have A clear bullish structure, a liquidity sweep below structure, a confirmed break of structure, a defined point of interest, and an inducement phase designed to trap traders. Nothing here is accidental. Everything has logic, everything has intention. This is how smart money operates. They don't react to the market, they engineer it. And in the next part of this breakdown, we will continue by explaining what happens after inducement, how liquidity is targeted next, and how smart money prepares for execution. Now that we clearly understand the structure, the break of structure, the point of interest, and the inducement phase, we can move forward and complete the story of this chart. At this stage, the market has already done something very important. It has trapped traders emotionally. Some traders are still holding buys from the top, hoping price will go back up. Some traders panic sold during the inducement move, and some traders are now trying to guess the bottom. This confusion is exactly what smart money wants. Now let's talk about buy-side liquidity. Buy-side liquidity is simply the collection of buy orders that sit above obvious highs. These highs are usually equal highs, previous session highs, clear swing highs that everyone can see. Above these highs, retail traders place buy stop orders, breakout buy orders. And smart money sees these levels very clearly. The market does not move to these levels by accident. It moves there to collect liquidity. Liquidity is the exit for large players. Without liquidity, smart money cannot close positions or rebalance risk. That is why price is drawn to buy-side liquidity, like a magnet. In this chart, after inducement is complete, the market's objective becomes very clear. Price is reacting from the point of interest, and the next logical destination is buy-side liquidity. This is not prediction. This is probability based on behavior. Smart money has already collected sell-side liquidity during the inducement. Now they need buy-side liquidity to complete the cycle. Now let's talk about entry, but very carefully. We do not enter trades emotionally. We do not enter because price looks cheap. We enter because conditions align. In this model, the entry comes after inducement. Why? Because inducement comes that liquidity has been collected, weak hands are removed, and smart money is positioned. Entering before inducement is gambling. Entering after inducement is following logic. This is one of the biggest differences between retail traders and professional traders. Professionals wait, retail traders rush. Now, once price reacts from the point of interest, execution becomes valid. But execution without protection, that brings us to stop loss. Stop loss is not optional. It is not a suggestion. It is non-negotiable. Your stop loss represents your maximum acceptable loss, your discipline, your survival in the market. In this model, the stop loss is placed below the order block or below the point of interest. Why? Because if price breaks and closes below that level, the idea is invalid. And if an idea is invalid, staying in the trade is not bravery, it is denial. Professional traders accept losses quickly. Amateurs hold losses emotionally. Now let's talk about target. The target is not random. The target is not based on hope. The target is buy-side liquidity. This is where smart money wants to go. This is where orders are resting. This is where price is most likely to be drawn. We are not trying to catch the top. We are not trying to be perfect. We are aligning our target with market intention. That is how consistency is built. Now let's connect everything together. Structure gives us direction. Liquidity sweep gives us manipulation. Break of structure gives us confirmation. Point of interest gives us location. Inducement gives us timing. Buy-side liquidity gives us the objective. This is not one concept. This is a system. And when you understand it, trading becomes much calmer, much slower, and much more controlled. If this part helped you see the market more clearly, make sure you stay subscribed. In the next video, we will go even deeper. This channel is about education, not signals. Understanding, not guessing. Process, not emotion. I'll see you in the next video.